Imagine sitting down on a Sunday morning to finally handle that credit card debt that has been hanging over your head for years. You log into your bank, you make the final payment, and close the laptop. You finally feel lighter. Then, a month later, you open your credit app. You expect to see a reward for your discipline, but the number has plummeted 47 points since last week. You look for an explanation, but there isn't one. You didn't miss a payment or apply for a loan. You were penalized for paying off your debt. This isn't a glitch in the system. It is a specific mechanical feature of the FICO algorithm known as the utilization paradox. To stop the score drops, you have to stop viewing credit as a grade on your financial morality and start seeing the mathematical fraction that actually dictates your score. Your FICO score is divided into 5 distinct buckets. After payment history, the largest factor is amounts owed, which accounts for roughly 30% of your total file. That entire 30% is driven by your credit utilization ratio, the amount of revolving credit you are using compared to what you have available. The math is simple. You take your current balance and divide it by your total credit limit. The trap is that if that bottom number shrinks faster than the top number, your ratio gets worse, even if you haven't spent a dime. You can look like a high-risk borrower to the algorithm without borrowing a single new dollar. You just accidentally collapsed the bottom of your fraction. Look at it this way. You have 3 cards with limits of $8,000, $2,000, and $2,000. Your total limit is $12,000, and you have a $1,500 balance spread across them. Dividing $1,500 by $12,000 gives you a utilization ratio of 12.5%. That is a stable, healthy number for your score. Now, you pay off that $8,000 card and the bank closes the account. Suddenly, your total available limit pool shrivels from $12,000 down to just $4,000. You still owe the same $1,500 on the other cards, but when you divide it by your new $4,000 limit, your utilization ratio spikes to 37.5%. By closing that card, you didn't just clear a balance, you amputated your available credit. The algorithm now sees a borrower who is much closer to being maxed out. Most people are told to keep utilization under 30%, but that is a baseline for avoiding damage, not for achieving excellence. Borrowers with the highest credit scores maintain an average utilization of just 7%. It might seem safer to carry a 0% balance, but the FICO model penalizes that as well. A consistent 0 provides no data on how you manage active debt. The optimal range is between 1 and 9%. Letting a tiny balance report at the end of the month proves to the algorithm you can handle revolving credit responsibly. However, the total average isn't the only variable. FICO also calculates per-card utilization to scan for specific points of risk. If you have a $900 balance across 3 cards, it's better to spread it out. If you put that entire amount on a card with a $1,000 limit, that 90% utilization sends a panic signal that empty backup cards cannot offset. The model looks for signs of stress. One maxed-out card suggests you are running out of room, regardless of your total limits. At its core, FICO is a prediction engine. Its only job is to estimate the statistical probability that you will miss a payment by 90 days or more in the next 2 years. This explains why 0 balances and closed accounts often cause scores to drop. They remove the active history the model uses to forecast your reliability as a borrower. Your credit report is essentially a set of statistical variables for a risk model, one that functions independently of your actual net worth or your personal integrity. The rule for paying off debt is simple. Never close the account. Make the physical card unusable, but keep that line of credit open. If the card has an annual fee, call the issuer for a product change to a no-fee version. This preserves the account history and the limit without costing you a dime. Keep the account active by putting one small subscription on it and paying it off at the end of the month. You want the statement to report that 1 to 9% sweet spot to keep the algorithm satisfied. Paying off debt is the responsible move, but to make it the optimal move for your score, you have to ignore your instincts and follow the math of the denominator.